Welcome to Books in Sum, your go-to for bite-sized book summaries.
Common Stocks and Uncommon Profits and Other Writings by Philippa Fisher. Common Stocks and Uncommon Profits, written by Philippa Fisher and published in 1956, contains timeless investment guidance. The best investment strategies look for companies that can sustain their growth over time. The goal of a savvy investor is not to make a quick buck, but rather to find a company with strong prospects for growth that can eventually multiply the value of the investment. Companies with growth potential share a number of characteristics, including the ability to offer products and services with high sales volumes for at least a few years, and the willingness to invest in R&D to ensure continued growth even after the current product line has exhausted its expansion potential. For instance, the middle of the 1950s was a boom time for television production. But by that point, almost everyone who wanted a black and white TV already had one. Successful investing is a lot like the work of a detective, and this book argues that companies with high growth potential have a strong management team and positive employee relations. When investigating a prospective firm, it is crucial to gather as much information as possible about it. To save time, pick out ahead of time the businesses you think have the potential to provide the return on investment you're seeking. Last but not least, it is prudent to watch for stock price declines in order to buy shares at a discount and profit from the subsequent price appreciation as the company expands. Stock prices are a reflection of how the financial community currently values a company, and this valuation feeds into itself, creating a vicious cycle. Businesses with significant expansion potential are frequently industry pioneers, and as such, they face unique challenges. As an example, consider a widget factory whose stock price rises as investors anticipate rapid expansion, only to fall when they discover that the casting mold they used was too small. There may be another chance to get in during the next dip if you miss this one. Choose wisely and resist the urge to second-guess yourself. A confident investor never has second thoughts. Once you've located a company with promising earnings potential, you shouldn't wait to dive in. The book emphasizes the need to buy when others are selling, to not let a stock's price fall further in order to get a better deal, and to not sell a good investment just because the price has dropped. Financially cautious people should look for well-established businesses with room to expand. Instead of funding new businesses, they should put their money into large corporations that have already shown they can generate a profit. The company's potential for future expansion is essential to the success of this strategy. Of course, this doesn't have to be on the level of a meteoric success. The book's 4 major characteristics of a strong and able-to-grow company are important points to remember. Among these are excellence in R&D, market dominance, a solid financial foundation, and efficient and cost-effective production processes. It makes sense to invest in your company's people because they are the backbone of any successful, expanding business. It's crucial to look into the working conditions at a company and find out how its employees are treated. Reason being, a company's growth potential is tied to the employees who put the company's strategy into action, and the way in which a company treats its employees can be indicative of the company's overall productivity and effectiveness. Reviewing a company's HR and management practices can shed light on its management style and help you assess its viability over time. A conservative investor prioritizes finding businesses that can sustain their profits over the long term. The size of a company's profit margins, rather than the total of its returns, should be the primary metric used by investors in making this determination. A company can ensure its long-term profitability by outperforming its rivals and developing proprietary technologies that its rivals are forbidden to copy. In addition, a company's strategy should anticipate and account for the company's long-term growth. Finally, the value of a stock varies from person to person, making it even more subjective than the previous points. A conservative investor prefers to put their money into steadily expanding businesses that are either currently undervalued or priced fairly. A conservative investor could use the price-earnings ratio, which is calculated by dividing the stock price by the company's earnings per share, to answer this question. You can use this ratio to see if the market's high expectations for the company's future growth are warranted by the company's actual performance. Conservative investors, to succeed, need to be curious and willing to do research. Use your bank as a resource and act on their advice. You must make it crystal clear that you are conducting this search solely for personal use, and that you will treat any information you obtain with the strictest confidence.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries. And feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.